Hello and welcome to Wake Up and Smell the Mic S&P 500 review for Wednesday, January 4th, 2023. It's now the 3rd. We start off in the S&P 500 daily chart in DeMark looking back to December 2021. I'll zoom into the current area now. The S&P 500 daily chart has printed the combo and sequential buy setup 2 count. And to negate that for end of day on the 4th, there must be a close above 3783.22 for the price flip to the sell setup 1 count again. So price could open on the 4th with a sell setup 1 count unless it opens or moves under that level. The only level in danger of becoming qualified is the 50% propulsion momentum up that's currently disqualified now at that level, with a close above that level at end of day on the 4th. And there's a good chance at getting this ongoing demand line qualified for end of day on the 4th. And for the 4th, the ongoing demand line will be at 3802.50. So if there's an open less than this close on the 3rd and subsequently closes under 3802.50 for the end of day on the 4th, this ongoing demand line will become qualified. And price had a high of 38.78 and a low of 37.94, so quite a range for the day, but still within the consolidation zone with a high of 38.90.91 and a low of 37.64.49. Here's the S&P 500 daily cloud chart looking back to end of December 21. I'll zoom into the current area now. There's an ATM long-term oversold down at 37.94.33. Doesn't mean much as it will continue moving down with price. If it gets lower than that, then this will be down here, etc., etc. But it is an indication of being oversold, and it looks like price closed below the conversion line, which is at 3827.15. There was a close of 3824.14 for the 3rd. Here's the S&P 500 weekly chart looking back to the COVID crash 2020. I'll zoom into the current area now. And we're stopping in over here to see that the conversion line at 3922.59 is above the baseline at 3908.43. So there was a positive crossover of the conversion line above the baseline, and that's a good sign. And to reiterate, the Ichimoku cloud chart is really meant for only the daily charts. But I use the conversion line and baseline in the weekly chart as it works out real well for this reason here. The monthly NYA chart with the long-term KST, Coppock Curve, and PPO chart. And you can see the monthly price has itself in some trouble. It's in a downtrend, but still above its 10 simple moving average in blue that you can see over here in the thumbnail. But we're more focused on the long-term KST, the Coppock Curve, and the PPO indicators. You can see that the KST has not made it down to 0 yet. So this is almost similar to 1987. You can see here, or 89, I believe, where the KST did not make it down to 0 and below like over here. And the Coppock Curve and the PPO did go under. And you can see the PPO started hooking around well before the Coppock Curve started straightening out. So that has not made it down to zero here yet for the long-term KST. But what I'm more interested in is the Coppock Curve. You can see in the thumbnail it definitely has a horizontal planing out, maybe a little uptick here, so this is a good sign. And the PPO has definitely hit this common valley zone here, just like the Coppock Curve in light blue. And it definitely hooked around. It looks like it wants to roll over again, but the Coppock Curve is looking a lot better than it has been. And this would be another indication of the soft landing, just like coming out of the 87 crash here, Black Monday, I think they called it, in 89. So if this can avoid going under zero and the Coppock Curve turns around and starts heading up along with the PPO, then that's the case for the soft landing. And here's the NYA weekly chart that shows all the rising wedges going back to 03. And we'll zoom into this area now and take a closer look. And look at this ascending, broadening wedge from the free money era coming out of the COVID crash. So April 2020 all the way to 2022. And you can see at the top I have it anchored over here where it started the mumbling, and then anchored it over here where it fell out of this somewhat horizontal pattern here. And then from around the same area in solid blue, I created this falling wedge pattern here. And you can see recently it broke above it and then fell back under it. And it's still under the 40-week moving average in green and above the 10-week moving average in gold here. So it would be good to see it get back above that green 40-week moving average, blast through the top leg of this descending wedge in solid blue, and start heading up. And here's the NYAAD line on the weekly chart here. So we're looking for it to get back above the top of this descending, broadening wedge pattern in solid blue. And that would be good for more upside, or it could break down to the bottom. And that would be another indication that we're in the secular downtrend and extension of the primary bear market within the secular downtrend, which is a lot worse than if it wasn't in the secular downtrend. Same thing with the stocks only AD line for the NYA. You can see that it's closer to the top of the descending broadening wedge in solid blue here. And the stocks only AD line is below its 10 simple moving average in red, just like the NYA AD line where it's underneath its 10 simple moving average in blue. If you've been following along with me for the past couple of years, you might have ascertained that I could care less about the big fat cap megatechs like Tesla. But look at that head and shoulders pattern going back to November of 2020 and ending just about in November of 2022 here. And if I was following along and made this head and shoulders pattern a long time ago and been following it, I would have shorted it here along with everybody else when it fell out of the neckline here, 47.4% down and further. And this is a picture perfect head and shoulders topping pattern. Here we have the left shoulder and it's about halfway up to the head here, so half of that. And then the right shoulder is about half of the head here as far as height is concerned. And the left shoulder is longer in length than the right shoulder. So that's about as perfect as it gets here. So price fell under the measure rule bottom here the other day and then bounced up. And then today there was a bad report of a missed production number. It was again a record production number, but did not meet the analyst requirements, which expected more. So that's 2 reports in a row where they were still record production numbers, but less than the analysts' expectations. So it fell under the measure rule again and formed a slight divergence that you can see better in the thumbnail. So the arrow pointed down here. And then my guy, Tom Asprey's MACD histogram, which he invented back in 1987. You can see the arrow here pointed up, and that's a slight divergence there. And Tom Asprey's indicator here, this MACD histogram, is a 4th derivative of price. I won't go into what that entails, but it is definitely a lagging indicator, and it's just a heads up that the MACD could possibly make it above its signal line soon, but it's still nonetheless a slight divergence. And price has gone below the measure rule, and if it keeps going, there's this light blue gap zone here going back to June and July of 2020. And you can see it here. There's one candle in the gap zone, so I just measured it at the top of this candle and this price tag here at 91. So it's quite a wide gap zone, so when it starts approaching 91, if it does, that's something to look at for Tesla. And here's Tesla in the DeMark indicator daily chart looking back to beginning of January 22. I'll zoom into the current area now. And I have a lot of the indicators turned off so that we can see these buy risk levels here along with the TDST levels. Here's a buy risk level here for sequential, another one for combo. Here's the aggressive combo buy risk level. And we'll have another one printed for tomorrow. It's not printed yet for this combo by countdown 13. So all of those levels are in danger of becoming confirmed, as they're all qualified now, as there was a down close on this bar, followed by an up close on the 30th, followed by the down close today. So if there's an open on the 4th lower than this close on the 3rd, ticks lower than the low from the 3rd, and closes below the close for the 3rd at the end of day on the 4th, then all of these levels will become qualified and confirmed, and I would expect more downside action for price for sure. And there's really nothing underneath here to look at for support, so we'll go to the weekly chart. And here's the weekly chart, and the only level nearby is this down projection for wave 5 here for down, and it's pretty close to that. Again, this is a weekly chart, and it has printed a aggressive buy countdown for combo, It's about to print another aggressive buy countdown for combo, and the sequential buy countdown is on 12 also, and the combo buy countdown on 10. So there could be a few more weeks of downside to get all more of these 13s printed. So other than that weekly down projection for wave 5 down, all there is this blue gap zone, so right around 91, and then down to 70 or so, let's see. And the top of this candle on the first is at 75.69, so 91 to 75. The S&P 500 support and resistance levels big board chart shows the gray area at 38.32, and price in the aftermarket hours for the S&P 500 on the 3rd at 5:57 p.m. Central Time is 38.22. And to the downside is the ongoing demand line, 3802.50. And to the upside is the daily conversion line, 3827.70. So get past that, and then we're going to go back to the 3870 zone. Trend factor down to S1, 21 EMA, R1, daily horizontal support. Then get past all that, and it's back to attacking the fortress Fed. And the Fed has his pikemen out in front of the castle in the form of the 20 simple moving average, 50 EMA, and the 100 simple moving average, and the weekly diamond bottom extension perfect uptrend channel. Again, this is where I'll be shorting here. I haven't decided what yet, but this is where it'll happen, and then start fading it there and then into the 3900 area. Here's a 2-minute chart of the S&P 500, or take that back, it's a 1-minute chart of the S&P 500 for the 3rd, and you can see the high here right near the open. A couple minutes after that, 9:43, was 3877.48, and that was right at this daily horizontal support from 01/26/2021, 3874 area, and the daily fortress Fed resistance at 3906 has boiling oil, archers, and trolls to fend off attackers if it makes it past the pikemen here. Daily qualified supply projection, the 50 simple moving average, that's a big one there. The top of the cloud, 26 bars back concerning the lagging line, the fortress Fed resistance itself, the top of the cloud, the daily high channel 3, and the weekly baseline. And here you can see the weekly conversion line above the weekly baseline for a positive crossover. And the NYSE traditional McClellan breath oscillator to get back to zero would require 189 decliners over advancers to get back to zero. So it's in positive. Let's go take a look at that. And here's the chart I use to call Hindenburg omens. Maybe we'll get one of those in the near future. I use it for the NYSE common stocks only advance decline volume ratio. And you can see that the 19 EMA at negative 10.42 is above the 39 EMA at negative 9.45, but they're still below zero, the both of them. A move above zero for the EMA 19 would be a good sign for some up move. And here's the New York McClellan breath oscillator, the traditional version, and yes, it's above zero, 8.57, so there were positive instruments in the NYSE today, not the S&P 500 and the NASDAQ though. Have a great day.